All right, so welcome to another video. Today we are going to take a look at LYFT and how do we compose an earnings trade. I'm going to show you two different earnings trades on LYFT as we go through it. So let's get started, and keep in mind none of these are recommendations to buy, sell, or trade anything, just my own personal opinion. All right, so now that we got that out of the way, let's see here. As we go into LYFT here, you can see we've got LYFT right there, earnings coming out after the market. So I'm going to try to put this video up very quickly. So that is that day. The basic point of earnings in general, they typically go with the market. So but if you're thinking, hey, this stock might pop, or it might go there, or it might stay here. So there's kind of three things that it could really do. It could kind of pop above, pop below, or kind of stay in this range and not move that much. You've seen that happen with kind of Take Two, where it kind of stayed in that range. Other stocks, for example, like Netflix, you know, they sold off, and stuff like Facebook as well sold off and been toast quite a bit. So, and even go past beyond the expected move. So if we look at LYFT, there's, I'm going to show you two trade setups here on doing this in one way or the other. So what you do is you look at the expected move. The expected move here is about $6. So they're expecting it to move about $6 in the next 3 days. Now the market maker move, this does not take into account the days here. That's expected to move about 5.5 points. If you want to use this move, fine. If you want to use this one directly tied to the options, it is 3 days. Okay, so we're going to go into the 3-day option. The first thing you could do is you could say, okay, well, LYFT currently is at $40. And I want to add in about $6. You know, this one's $5.50. This one's about $6. So I expect it to move to about 46 to the upside, or you take 40 minus 6. So now you'd say, okay, 34. So it can go either to 34 or 46. That's kind of the guess. Okay. That's the expected move. Now you could put it right at the money and say it's not going to move much at all. It's going to move less than the expected move. That's also possible. And the point of doing these earnings trades is, let's say we've got a butterfly here. We're trying to take out the volatility out of these options, because there's a lot of premium baked into these options. We're trying to inflate it, so it's going to puff up like a balloon. So if you normally are used to doing a 30-day trade, basically what happens is you're taking all of that 30-day premium, or let's say like half of that, and just cutting it out, deflating that balloon. And that's what you're doing. And one day, boom, it's out. And that is because there's this news factor baked in. So I'm going to go ahead and pop this right around that $46 price level. And I'm going to do a butterfly. Calls if you're doing bullish, puts if you're doing bearish. So this is one way of doing it. I'm going to go in and do a butterfly right there. We will analyze that trade. I could even do a 45. It might be a little bit more of a nice rounder number. It's, you know, it's a 5-point move, still kind of within that range. So if you're struggling to get some of the fills, or if, you know, you could kind of, with stocks like this, maybe tweak it. So what you'll do is, in this case, I'm going to go in and say, I got a 2-point wide spread here, 2-point wide spread here. I could even do a little bit wider, but what you don't want to do is, make it too wide to where the probabilities just do not work in your favor. So in this case, I've got like a 45-cent trade, you know, and if it pops right here, that's kind of what I'm looking for. Just a little pop and, take your money off. So I've got a $43 spread. Just risking $43 in these earnings trades. You just have no idea if it's going to pop or drop. And typically you might even take it to the full max loss. So you have to be prepared. Earnings, it's a guessing game. That's the reality of them. Now you could just risk $20. It's not too bad. Put in $20 on a trade, and then you'll see you're probably going to try to, all that volatility will come out. You'll probably try to make, you know, $20 off of that as well. So on these, you're really aiming to maybe win 1 out of 5, 1 out of 4. So that means if you take $20 loss, like I take a loss of 20, a loss of 20, loss of 20, loss of 20, and then you basically, eventually, boom, you make like 80, and then you're kind of breaking even at that point. So you don't have to win a ton of these, because these are cheap trades, but you only need to win them periodically to just keep breaking even. So that's the point of them, is cheap trades. So this is one trade setup I'm going to show you right here. So we'll go to kind of today. I will try and get it filled at, let's say, 16 cents. You can put it in, and let's say we go in and it is a spec trade for that, and we'll let it work. So that's one type of earnings trade. Another earnings trade you could do is, let's say you think the move is going to be less than the expected move. Maybe it's just going to hang around where it's at. What I could do is do the similar concept with an iron condor and say it's going to move within the range. These are a little bit more tricky. So again, I'm looking at a 34 kind of, okay, so 34 and a 46, right? So I'd rather be outside of that range. So here I might say, okay, about 34, and I'll do 33 just to keep it very tight, because if you go wider, then you might have a little bit more of a problem. Okay, next thing, 46, and I'll do 47. My problem here is going to be with this butterfly. I'll just show you the concept though. Okay, so now I've got this right here set up on this trade. So now if it kind of just moves up a little or there, or even it just pops up right here and starts pulling back, I'm kind of back in my sweet spot. So this is another way of doing this trade. And what you could do is kind of pop it in. My problem is going to be with this butterfly if that butterfly gets filled. So maybe I'll do a 2-point wide on that. Let's go 48. And then I'll do a 32 right there. So I'll do something like this. So I'm risking about 129. And it'll try to inflate that. So maybe I'll try and get away with like $40, $50 on this trade. But this obviously can go way outside that range all the way over there. And that could be a problem. Then you get out of the spread. So the way that you might do this spread is the minute you've got it on, I know it's either going to pop up or down, you know, or stay in the middle. But my objective is once I get this in, here we've got a spec trade right here. Once you've got this trade in, what you'll want to do is take the short end at each one and kind of set it for a fill to get out at a, you know, couple pennies, because that side is going to be worth nothing. Boom. So you'll kind of get out of it. So I'm going to go ahead and let's see if I can push that order a little bit more. And I'll show you how to do that. Because the risk in these trades is basically that the short leg with the iron condors, that the short leg is actually the problem. So we want to make sure we take good care of that and get out immediately for at least the one for a profit, and the one that's at a loss will kind of manage that trade a bit. So you can see I'm having trouble filling a little bit, and normally you want to work this trade a little longer than what I'm doing here, but the principle is kind of the same. You just kind of wait a little bit, let it sit there for 5 minutes, move the price, try and get filled. And once you get filled, so I'm going to try and push that order a little more for video purposes and see if I can get filled. There we go. We got filled. So now what would I do? So I've got in this trade, you can see it's not as favorable, but I take this leg, analyze closing trade, and I'll take this leg, the short leg. So I'm taking the two short legs. The reason is those are going to be my problem areas. The ones I bought, there's no risk associated with them except the loss of what I paid for them. And this short leg, analyze closing trade, you can see right now they're trading 76 cents and 103 for this one. So I got a call and a put. What I'm going to do is go ahead and create a duplicate order. I'm going to go ahead and pop this in for 5 cents on, let's just say good till cancel. Okay. And I'm doing them individual because I want one or the other getting filled. I don't know which one's going to get filled. So I'm trying to buy back the short leg, and I'll create this one as well, create a duplicate order for 0.05 cents, and then good till cancel. Okay. So tomorrow, as this opens up, boom, those short legs one of them will be gone. And that's kind of what you're looking for. And you'll see that these orders right here are kind of working. And usually once they kind of push that way, one way to the left or the right, that leg will be gone. And that's what you're aiming to do with those short legs on the earnings side at least. And then you work the other side manually. You might have to do it by singles or verticals. But anyway, as long as you get out of the short legs, then the assignment risk becomes a lot less. But you're trying to get that premium out, collect your profits, done, move on kind of thing. With the butterfly, you put it in as a whole trade. It's a little bit better, but sometimes tricky again to work that trade. Right now, I haven't even gotten filled at the butterfly yet. So we will see if that'll get filled. We'll see if it'll push it through. But you're kind of aiming to get, there we go, got it filled. So you'll see, and you can evaluate, you could do a bullish move, a bearish move, that kind of thing, just depending on your directional bias. But you're just trying to do smaller sizes because these can actually go to a full loss when you're talking about earnings. So anyways, I hope that helps, gives you some insight and a little bit of thought for LYFT. And then maybe tomorrow you could say, hey, it's party time and the stock did really good job, or it it did poorly for you and then you take it off. But remember, it's a low probability trade, but when you win a little bit bigger because the risk to reward is fairly favorable. Anyway, thanks for joining me. Enjoy the rest of the week ahead, and I will see you in the next video. And don't forget to subscribe on Discord or also our mailing list, so that way you get notified as we release new great classes like the class we've been doing right now, which is for swing trading, technicals, and much more.